Ladies and gentlemen, we are Team AD and we are proud to present our research for CFA Institute Research Challenge. We will present our stock valuation and financial analysis for Alrosa Group.
We issue a sell recommendation for Alrosa with target price 62 ruble. We utilize discounted cash flow and comparable company analysis to value the company. We attribute equal weights to each valuation model. Total rough diamond production is calculated by multiplying ore processing with its grade. The company projects decline in production due to difficult mining and geological condition at Ljubljana Open Pit Mine, International Mine in 2018-2022 and exited at Mir Underground Mine. Alrosa will lower its production for 2020 by 6% to 34 million carats and expect to grow in 2021 to 37 million carats as a result of the bringing production to full capacity at the Verkhneyamurskoye field by 2020 and Udachnoye mine by 2021. Total diamond available for sale is projected by taking into consideration both remaining inventory and diamond production for each year. Company expects to lower diamond sale from 38 billion carats to 33 million carats in 2019. With taking into consideration high correlation between Alrosa diamond sales and US GDP growth rate, we expect 1.8% and 1.56% growth in 2021 and 2022. Then we found the quantities for each segment and multiplied with their average realized price to find the revenues from main operation. The company expects 21% decline in gem quality diamond price in 2019 and 2020. We expect 2.1% increase in gem quality and non-gem quality diamond price due to US inflation rate for 2021 and 2022. Diamond sales highly sensitive to the US dollar and Russian ruble exchange rate and will lower 27% in 2019. Total revenue is calculated as a sum of revenue coming from diamond sales and other activities such as gas, social infrastructure, and transport. Capital expenditure of Alrosa consists of maintenance, expansion, gas assets, non-mining operations, social infrastructure. Maintenance change as a percentage of revenue and expansion, gas assets, non-mining operations, social infrastructure are expected to increase with the Russian inflation rate. Free cash flow to firm is suitable for Alrosa because the company has fluctuating amount of net borrowing. Additionally, the company has made some change in its dividend and financing policies. According to our detailed discounted cash flow analysis, we expect the target price 67 ruble, and which is average of the price for exit multiple method and the perpetuity growth method. We forecast earning before interest and tax through 2019-2022, and we adjusted tax rate, depreciation, change in net working capital, and capital expenditure. Free cash flow to firm growth rate beyond the 2022, in other words, terminal growth rate is equal to the 2.3%, which is equal to long-term Russian GDP growth rate. Exit multiple method is calculated according to median of the EV/EBITDA ratio of the diamond industry for 2019. The cost of equity is calculated as a sum of risk-free rate and equity risk premium using capital asset pricing model. Cost of equity is equals to 12.9%. Cost of debt is calculated by adding risk-free interest rate to long-term industry and company spread, and after tax cost of debt become equal to 8%.
After choosing appropriate peer group companies based on their physical and financial size, we conducted our multiple pricing valuation method by using price to earnings and enterprise value to EBITDA ratios, both based on 2-year forward medians. We assigned equal weights to both rates and years in our valuation, and the price we derived from such a combination is equal to 56.75 rubles per share. The revenue is forecasted based on one of the main drivers of the demand for diamond market, which is US GDP growth rate. We expect decrease in revenue in 2019 due to diamond market crisis and recovery in next 3 years depending on gem and non-gem quality prices and our production expectations. In small proportions, company will continue to have revenue from social infrastructure, gas and transportation. We expect decrease in net income by 47.81% in 2019 due to decreasing level of sales and increasing level of cost of goods sold depending on macroeconomic factors. Return on equity of the company will be lower than previous years. According to our DuPont analysis, the main reason for lower return on equity is decreasing level of net income margin. Company had historically high level of liquidity ratios and we expect that it will continue to have sufficient level of liquidity ratios in the future. According to our expectation on cash flow statement, the company will have negative cash flow from investing activities due to high level of investment and fixed asset purchases. It will have negative cash flow from financing activities due to high level of dividend payments, but it will have positive cash flow from operations which will be able to cover its capex for 3 times in the future.
This company expects to expand the production in northwestern regions of Russia and in Africa. The company is a world leader in industry because of a single product strategy. The company increased production from 34 million to 41 million during 7 years because of its strategy.
Diamond industry is well established and supports economic development and employment in many countries. Oligopolistic system, scarce resource base and huge capital investment are main features of current diamond industry. Overall, the size of the market was valued at $87.31 billion and expected to increase at a 3% growth rate from 2019 to 2030. Overall, the demand for the diamond is expected to increase because of increasing middle class population and disposable income in India and China and sustainable GDP growth rate in USA. However, the supply is expected to decrease because of oversupply of rough diamond, increasing financial strains of middle players, and the stoppage of some mines like Argley in a remote region of Western Australia. The value chain of the diamond involves upstream, midstream, and downstream market. The upstream market involves exploration of rough diamond, and Alrosa operates in this part of a value chain. Alrosa is a market leader with 26% market share. The midstream process involves polishing and cutting of rough diamond, and in this part, India is the market leader with a 90% market share, and even with a 3% decline in the net exports. However, in 2018, Alrosa acquired state-owned polishing company Crystal, and as a result, the share of a Russian polished diamond market is expected to increase from 20 to 70%. The downstream market involves jewelry designing and selling, and actually there are 4 key players in this part of a value chain. In 2018, 96.2% of the revenue came from the sales of a natural diamond. However, technological advancement put the natural lab-ground diamond into more competitive use, and as a result of this technological advancement, the cost to produce per unit of a diamond, lab-ground diamond, decreased from $4,000 to $300. Also, one of the biggest competitors of Alrosa, namely De Beers, introduced a lab-ground diamond, namely a Lightbox, which means that the share of a lab-ground diamond is expected to increase in near future. Alrosa's main risks include market, operational, economic, and political risk. The market risk includes fluctuations in the sales price of a diamond and fluctuations in foreign exchange rates. Company's main revenue comes from the sales of a natural diamond. As a result, any price fluctuation will have a negative effect for Alrosa's earnings. Also, the company's costs are denominated in ruble, while its revenue comes in the form of a USD, and a huge portion of the revenue is related to foreign currency transactions. Strengthening position of the ruble will have a negative effect for Alrosa's earnings and will decrease the company's revenue as well as share prices. 33% of the company's shares are owned by the state, and another 33% is owned by the Republic of Sakha-Yakutia. It means that Alrosa is subject to political risk more than its privately owned firms. And state has the power to influence major decisions like investment in risky areas. Operational risk actually relates to the stoppage and depletion of mines like Mir Mine and another. Also, the economic risk includes competition. One of the biggest competitors of Alrosa, De Beers, introduced lab-ground diamond in 2018, and it will have a negative effect for the natural diamond sales of Alrosa, which is one of the biggest risks.